pick that I started to look at was Cadence, CDNS. It's a B minus rated stock. And the reason why I was drawn to it is because of the recent trends in AI and becoming like the buzzword. Everybody's looking at it and everybody's kind of wondering which stocks to buy to be able to get exposure to artificial intelligence. And so I started looking at Cadence and Cadence Design, and I found out quickly that AI has been around for many, many years already. It's not like it just came out a few months ago and everybody's kind of waking up to see it. It has become more prevalent recently because of strides in OpenAI, ChatGPT, and Google Bard and things like that, and more offshoots have been created to be able to use AI. So that was one interesting thing that I recognized. And what Cadence does is they're a semiconductor design company. So they have a supply chain where they use chips that they design themselves or design in conjunction with other manufacturers. So they have their suppliers are companies like AMD, NVIDIA, and so forth. And then they use their proprietary design mechanisms, even AI, to help create more efficient, powerful hypercomputing chips that then go to other users, other AI companies, or other hardware developer companies like Apple, LG Electronics, for use in their processes. This company, about 85% of its business is in software, and they create these chips and they license them out, or they sell them, and they've been doing it for quite a long time. And this company is actually, the top line has grown by 13% in the last year, 25% income in the last quarter. And it generates around 250 to 300 million free cash flow per quarter. Now the only issue is this AI buzz has become so strong that this stock is up way ahead of the averages. We talked about 25% for the Nasdaq. This company's up like 45%. So it was one of those things where you're buying a stock because of what you think is good fundamental. It has sound fundamentals. It's a solid company. It's beat earnings expectations in every single quarter since 2018. So that's 5 years worth of beating. The average price change after those beats is plus 4%. It's been as high as like 10, 15%. So excellent in terms of beating guidance, beating expectations, continue to grow the top line, bottom line, and all those things are great for. And actually, I've noticed that there was a closely related peer that has the same revenue breakdown in terms of design for the semiconductors, IC chips and PC boards, and that company almost like line for line has similar growth, similar projections, similar off takers in terms of customers and supply chain. And the one thing that helps Cadence against that company, which is Synopsys SNPS, which is also rated B minus, is also on that list of strong tech companies that we rate by, is the management's effectiveness. This company has a 14% gross margin, 14% return on assets, and a 30% return on equity. So the management is using that capital structure effectively, has strong returns for customers, and makes this company a little bit more attractive in terms of those metrics. Now, the one caveat is that because this company has traveled so far so fast with this AI buzz, valuations are quite lofty. It's trading at a historically, it's traded at a 23% premium to its comps in terms of a price to earnings. And right now, it's trading at almost 40% premium. That's the same for EV, EBITDA, EBIT, EV to sales, price to book, all of those are quite lofty. It's trading, used to be trading at 30 to 40 times free cash flow. Now it's trading at over 50 times free cash flow. Now it's going to take some time for this company to fulfill those valuations, but they are on the right track. I don't see like a ton of downside, but what it does is makes this company much more volatile. Because it's one of those hot stocks that have gone up, and you're going to see some profit taking, you're going to see some trading in the stock. And because of that, the volatility, and because of the higher valuations, the stock actually got a downgrade by our ratings from B to B minus. It's still in the buy category, but it kind of, when I was researching the stock, I was trying to get myself around, like, what's the overall story about the stock? Like, what do I do as an investor? It's in the right industry. It's a leader. It's proving itself financially. Problem is it's been recognized for it. It's been pinpointed by investors, and the price has been increasing considerably because of that recognition. So what do I do as an investor? Do I jump in or buy at these levels? And the ratings model is also saying the same things. But it's time to kind of like take a look at this as for what it is. It's a strong company, but valuation and volatility is now higher. So this is one of those stocks where you want to have it in your list of companies that you like, and look for a pullback and try to add on pullbacks, and to try to use some of that volatility to kind of dollar cost average your way into a name like this if you're interested in it. Yeah. The other thing is that the company also announced is doing a $200 million share buyback program. And that's another, like a point from management saying, hey, listen, there's no better investment than investing in ourselves. We see the outlook's positive, and use some of that free cash flow to buy back our own shares and return more to shareholders in that perspective.
Wow, you said that with one breath, Mandy.
Sorry, it seemed like it. That was great.
I was looking at the stock price there. Yep. Just over $200 at the moment. Does that mean you think they might actually do a stock split? Because if they're buying back the stock and they've risen so fast, it's starting to look like an expensive stock, and that's not where they're at normally. So if they're in the 150 mark, something like that on a more recent average, don't you think there's a possibility that they might do a stock split?
Yeah, it's possible. I would say so. The other company that I was talking about, Synopsys, that trades around $400, and they both have around 63 billion in market cap. But yeah, I mean, to make this a bit more a little easier for investors to be able to buy more shares. It's good for your mind and the mental. You're getting more shares. You feel like you get a bit more ownership in the stock. That would be something that would be good for shareholders. I can tell you that the company hasn't done a stock split historically. They don't have any record of that. They're more in terms of doing the share buybacks.
Right. I mean, I was thinking that your concern, it seemed a reasonable one, that they're starting to get quite expensive relative to their earnings, and that with other companies that we've seen over the years, when they've done a stock split, that's maintained that momentum. And it seems to be that tech stocks react well to that sort of thing. And if they are as strong as they appear to be from what you've said, then that might give them a little bit more or larger, longer legs for their stock price going up, even if their performance is just maintained as it is, their growth is maintained as it is.
Yeah, I agree. It's really great for the optics of a purchaser too. You see the stock that's been trading around 200, 250. And now it's, if you do like a 2-for-1 or 3-for-1, 4-for-1, you're trading at $50, all of a sudden, all right, cool. This is something I can get into. It kind of creates like a illusion of like it's now it's cheaper than it once was.
Yeah. I mean, it's certainly, and if we look back at some of the giants now in the tech world, they've done multiple splits, and it just fuels them because if they are a good company, then they are a good company, and it certainly seems that they are. And as you say, AI is flavor of the month for good reason. This is not just some sort of meme stock. Absolutely, there's good reason that AI, where used appropriately, is certainly going to be a very large part of the future. When we get to the one that I'm talking about, there'll be some similarities with what you're saying.
And interestingly enough, one of the other companies that we're looking at is JetBrail, and that's one of their suppliers as well.
Right, and I wasn't going to mention them, but of course you brought them up.
Sorry.
But you know, the thing is that from what you said, this is a supplier to companies, and they have suppliers, and the companies that are the end producers are using multiple different types of supplier. And this is a web of essential services for end products, and if they are in the right area, then there's tremendous opportunity for growth.
Well, Gavin, I think you said a really important word there, web, and I don't mean the World Wide Web, meaning people are looking for portfolio construction or thinking about using the Weiss ratings. What oftentimes gets missed is we're investing in companies, right? I mean, these are businesses no different than the mom and pop shop down the street where you frequent it because the owner. The owner always greets you by name. They always have your favorite product, and I think investors really don't do that very simple analysis much credit. I think Warren Buffett has done a good job in trying to communicate that at the end of the day, we're investing in businesses, and to do it properly, we really do need to understand that aspect, like you just said, the web, especially for technology, because no tech company really stands on its own. We just looked at two companies that even down to the charts look very similar. Mandeep, you already said it. They've got a lot of the same how should we say, factors that are fueling the business. And I think one of the things that people sometimes miss as they're looking at the sea of information available is it really does help to start with the basics. What does the company sell? Who are they selling it to? And why are those people buying it? And then looking at the people that are buying it and starting to think about, well, what are their businesses based on? So it really helps in technology to start to think about what's the web or the halo or whatever you want to call it. Where do the tentacles go? And the more tentacles there are, the better. Particularly for companies like these, where you're really talking about almost like an infrastructure play for. We don't say it anymore, but you remember the old days when we used to call it the information superhighway. So it's like that. We're talking about companies that are plugged into truly the infrastructure of how the pipes and the internet roads are connected. Yeah.
Yeah, it's critical. I mean, the end producer, shall we say, the product that gets out to the business or the consumer is absolutely dependent on multiple suppliers. And where those suppliers are based, who they are, what technologies they offer, they're all critical, and it's just something that we cannot escape. And sometimes you're better off being a supplier to an end producer, the final manufacturer, than you are in being that final manufacturer, because you can have multiple customers for your products.
Yeah, it's like selling the picks and shovels in the gold rush versus being the person prospecting.
Exactly. I may not have been fun making picks and shovels, but it's a whole lot better than being the one right exposed on the rock face, or digging into the mountain and just hoping that you're going to strike gold.
Well, and taking the analogy one step further, when you're talking about technology stocks, you're talking about possibly a global sales force, certainly a domestic sales force, wherever that company is headquartered. And a lot of times we miss the reality that, hey, salespeople get poached really easily if you offer them more money, a better comp plan, more stock options. And I know we're not talking about pure play internet stocks, but people don't really realize that Groupon rose to prominence because they found one of the preeminent sales forces in America. Those people started selling Groupon to small businesses. And then, like I just said, that sales force got poached by a company that saw their success. They had more stock, more cash. They just went to them and said, hey, we'll give you guys a $10,000 bonus per salesperson. We'll give you a better comp plan. Come over and sell for us. And once they did, Groupon all of a sudden started to decline. And an investor who maybe doesn't know that or isn't that intimate with a stock is probably going to miss it. And of course, a not so subtle plug for Weiss Research, those are the kind of things that we do find. What we were talking about before, I don't know if we were on recording or not, is that we love those rabbit holes. We love digging into the nooks and crannies, because at the end of the day, when you're talking about a business, the more you know about it, the better an investor you're going to be, because you're not only going to know more about that company, but who their customers are, who their suppliers are. It's just sort of this beautiful natural extension that happens where the investment ideas really just quote unquote fall in your lap. But it's because you're not just looking at a chart or, looking at an EPS or one, metric and trying to make an investment decision.
Right. You've hit the nail on the head there, so with the whole point of our ratings is to give folks an opportunity to be an informed investor. We're not telling them to invest in a particular stock. They need to do their own due diligence and to make sure that this is the sort of company that they want to be in. I mean, by all means, follow us and take really serious good note of what we are suggesting. However, you should get to know the company, and it's better for you to do that. Know what you're investing in, and just use us. We are a tool. We are a way to give you a good direction, and you can trust us that we are going to do our very best to guide you in the right direction all the time.
Yeah, well, speaking of that, Mandeep, you already mentioned J-Bill. You want to jump over to them or different one?
Well, J-Bill or J-Bill, or I'm not even sure quite how.
On the trading desk, that's what we called it, was J-Bill. I'm sorry. I made a casual mention in our chat. I made a bunch of money on whatever J-Bill options back in the day. .com bubble.
We can do that. I didn't know if Al wanted to pitch in a bit on Cadence, or whether he was just
he's playing Galaga.
No, I think it's I agree with Mandeep. It's a great exposure to the AI hype for the next couple of years. We know how this is going to drive, a lot of, given the AI integration into so many different business elements and business concepts, this is going to be a major driver for the tech industry and other industries that apply AI, that's for sure. And I think Mandeep didn't leave any stone unturned. That he's covered it from all the bases. If there is a concern, it's the valuation, as you've said, they're trading at a premium for a reason, obviously. And we've seen so many companies in the past treated with a major premium to their peers and historical falls so wrong for all the right reasons. Their solid balance sheet. I was going to ask Mandeep about their balance sheet. I was take a quick look. They're very low on debt. They have a very high quick and asset ratios. so they withstand any kind of shocks. So it looks really an interesting company to kind of, as Gavin and Eunice said, that we're just giving you the tool you need to do your own due diligence and dig deeper. That said, given the quick roundup that Andy looks a very interesting opportunity, and it could continue to trade at a major premium. Even this premium could increase given their growth and the potentials in the coming periods/years.
Well, one thing to talk about, again, shameless plug here is, so I'm on the statistics page for Cadence on the Weiss Ratings website. And if, just looking at the right side of the screen, if there's anything that suits humans most are relative comparisons. So when we're talking about what makes a good company, obviously on the left side of the screen, you're seeing all of the line items, profitability, which is broken down into operating margin, profit margin, management effectiveness, return on assets, return on equity, et cetera. But a single number doesn't really, a single number is meaningless. So if the return on assets trailing 12 months, which by the way, if you don't know, that's what TTM is, trailing 12 months. So if we're looking at just 14.21%, again, on its own, that's meaningless. But then looking over at the graph where we can look at some kind of comparison, and everybody's going to have their magic comparison. None of them are magic. It really is just that you need one. So that's one of the benefits of looking at a screen like this on Weiss Ratings is at a glance, you can not only see what's the snapshot, which is 14.21, you can see how they're performing to their average, but then you can start to take that information and compare it to other stocks. Now, I'll make a side note here, which is going to be a theme with me personally. One of the ways that our viewers, listeners, and certainly our members can use these particular pages is in conversations with your advisors. Well, obviously, we're not investment advisors. We can't tell you to buy a particular stock or give you specific investment advice for your portfolio. And the reason why is because, frankly, we'll go to jail, right? That's illegal. You've got to be licensed, and there's got to be oversight for, obviously, the investor's protection. But when you're talking to your advisor, this will give you points to talk to them about, because you've really got to be careful with most advisors. They are driven by commissions. They are driven top down. Oftentimes with some of the larger firms, they may own particular stocks and they may want to sell you those stocks out of their inventory. And there are lots of reasons why you may be getting information that does have a certain bias. And I don't mean bias in a negative way, or these are evil people with their, rubbing their hands together, smoke-filled rooms where they're, cackling about how they're going to steal money. But people have their own personal preferences. And at the end of the day, the reason why the exchanges require companies to report on these specific line items is it means it's a level playing field. Every company in the public market has to disclose these same numbers. They have to disclose them at least every quarter, or they don't get listed. And the reason why is these are the numbers that are meaningful for the health of a company versus some other number, right? So that's, as a baseline, that's what we have, is we have numbers that are reflecting how well a company is doing, and more specifically, how well the people are building that company, and hopefully having that reflect in the stock price. We're adding another layer, which is the relative comparison. So you can sit down with your advisor. If they're recommending a different stock, you can ask them, well, what's the management effectiveness look like? And if they don't know, or if they give you some other answer, then, well, the return on assets are X, and according, based on their 2-year average, they're doing better. If they're not giving you information like that, you can start to ask better questions of your advisor to really get to the bottom of why they're suggesting something, and truly get the advice from them that you need, or frankly, hire somebody else.
That's a really good point. A lot of these investment advisors don't have or don't look at this kind of detail. So if you're prepared, you're educated, we provide the resources to be able to do that. You'll be that much better off when you're asking those kind of questions. So your advisor is going to take a step back and be like, all right, cool. This person has also obviously done their homework. Let me readjust the way I speak to this person, and it might perhaps even my offerings.